Hi, I'm Sumaya Al Jaziri, and with me is Anoop Fernandez to discuss Seco Research's view on basic materials. Hi, Anoop.
Hi, Sumaya.
Before we go into 2023, how did 2022 shape up?
Sumaya, 2022 was undoubtedly a tough year due to the sheer magnitude of events that shaped it. But while many commodity prices, ex energy, saw significant drawdowns from levels at the start of the year, much of it was perhaps not too surprising. We did call the turn in the inventory cycle at the start of 2022 when consensus was still focused on the supercycle narrative. And Sumaya, there are two reasons why the inventory cycle is so important. One, the business cycle to a surprisingly large degree is an inventory cycle, quoting one of the former Fed governors. And two, given that the upcycle in 2021 was so large, one should have expected its unwinding to also be reasonably large in amplitude. So surely higher rates, energy crisis, diminishing wealth effects, inflation, war, etc. were catalysts. Lastly, it wasn't hard to see fertilizers come off a lot from the highs either. But what really surprised us is the duration for which these prices, especially ammonia, stayed so strong. So for much of 2022, fertilizer stocks did a lot better than we expected them to.
So, how are we doing in 2023?
Much of the landscape for industrial commodities is intertwined with global manufacturing output. So we entered 2023 with much of the world's manufacturing space in a slowdown. PMIs in the US, Europe, and China, which together sums up to much of global output, they've been signaling weakness. In China, this PMI has been signaling contraction for some 8 months now, along with a contraction in so many end-use sectors. Needless to say, this has impacted commodity demand and prices. These remain headwinds in 2023, but it is also important to note that we've been in some downtrend for a while now.
So, but now China is reopening. Isn't that a tailwind, or how does this change things?
That's right. China is a very large economy and in the past has been the major driver of global commodity demand. Now that has taken a backseat ever since China adopted a zero COVID approach. And then we had the crisis within the real estate sector during 2022. So we are not too sure if the Chinese government would want to bring back the real estate excesses. The premier recently emphasized that real estate was not for speculation. These are strong words. So while we may see work on standard projects pick up, and perhaps it already has, if the price trends in iron ore, PVC, or anything to go by, our bet would be mostly on the consumption side, and derivatives of that would be energy, food, and stuff like packaging and clothing.
So, our coverage in Seco Research broadly spans the petrochemical, fertilizers, and metal mining space. How does all of this read across the basic materials sector in our region?
So we've had a strong setup for fertilizers on the demand side, and grain markets suggest that this theme will continue as governments world over try to avert a food crisis. But price of these fertilizers is a different game. Typically, and there may be few exceptions, commodity prices tend to settle within the prevailing cost curve, and demand merely determines the point within the curve where the price is going to settle. So what did we see in 2022? An energy crisis in Europe, which relegated the continent to a marginal cost producer. We saw capacity cuts as gas supply was rationed and prices went to the extremes. But we also saw affordability of these fertilizers fall a lot. And as a result, we may have seen substantial curtailment in application through the year. Fast forward to today, and European gas prices are substantially lower. Europe has managed to build stocks of gas to its second highest levels over the past 10 years and has managed to pull through thanks to other sources of supply and a warmer than usual winter. Now, current prices of gas imply lower nitrogen prices, but we do see demand returning due to better affordability. So for producers in our region, fertilizer producers, it would mostly mean year-on-year weakness in earnings, even as free cash flow yields look very attractive. So in that tug of war between earnings disappointments, earnings weakness, and higher free cash flow yields, we think fertilizer stocks will probably be range bound for much of this year.
So, fertilizers would be range bound waiting for further direction of gas prices. And what about petrochemicals?
Sumaya, we see strong underlying fundamentals in fertilizers, that's right, but petrochemicals are mostly the opposite. There are expectations of large capacity additions in the US and in China and across products, which is PE, PP, MEG, polycarbonate. But then industry margins had cratered during the fourth quarter of 22. So if you look at ethylene over the past year, saw its steepest drop since the global financial crisis. And at one point late last year, we saw ethylene price in some USD 40 barrel per barrel of oil. So we've seen significant margin weakness within the polypropylene chain and also in MEG, where margins in 4Q were at 20-year lows. Now, why is that important? Typically, we tend to see some supply response and delay of capacity arrivals when margins hit the trough. But beyond that, the speed and the extent of margin recovery will depend on China's reopening and how fast consumption there normalizes and pushes demand higher. So corporate earnings typically look very bad at this point in the cycle, but when we look at asset valuations of these petchem names in KSA, we are approaching, what historical trends would suggest trough levels. So given where we are in the cycle and on valuations, maybe petchem names look better if one takes a longer term view.
And what about metals, Anup?
So within metals, aluminum is the primary commodity within our coverage. And just like ethylene, through 2022, it witnessed the steepest drawdown since the global financial crisis. Now, given where energy prices are, we see strong cost support. Other components such as coke and pitch have also risen a lot. And in general, if you look at smelter costs, they've risen substantially year on year. So Chinese smelters are in the red now. And our readers would recall that a relatively bearish call on prices early last year, was driven by, of course, the inventory cycle, but also a profitable Chinese smelting industry, which took production to a new record in 22. So we are now months into the former, and the profitability trend is flipped. So perhaps prices have a stronger support now. Meanwhile, exchange inventories of aluminum are close to multi-decade lows. So as and when we exit the slowdown, we will probably do at minimal system-wide inventory, which could make the aluminum market very sensitive to any supply disruptions.
So many moving parts, Anup. Any closing thoughts?
Yes, Sumaya, you got it right. So many moving parts. There are so many possible outcomes when one looks at the backdrop. So listeners should note that these are our views based on how things stand today, and the outlook will evolve as the backdrop changes.
Thank you very much, Anup. This was very insightful. If you are interested in our research and not a client already, kindly register on our research website and we'll get back to you.